It's time for the big picture. For that, we welcome in Collin Martin, director and fixed income strategist at Charles Schwab Center for Financial Research, and Mike Townsend, managing director of legislative and regulatory affairs at Charles Schwab. Welcome to the show, guys. Collin, I'm going to lead off with you because I just had a discussion with Chris Whalen. I followed him for years about the Treasury market and the volatility that we've seen in there. We got a little bit of a reprieve from those higher yields that we saw earlier on in the session, but it starts to feel like this is becoming a real problem, not only for the bond market, it's also for the equity market and maybe confidence here.
Yeah, I think confidence is the thing that we want to point to. I think that's the big question we're seeing right now. Are we beginning to see a loss of confidence in whether it's the U.S. dollar, U.S. treasuries, or just the general idea of loss of confidence in the U.S. government? You know, we're not sure. I think there's a whole confluence of factors that have driven yields higher. You know, one thing that we could point to is just all this uncertainty out there. Owning bonds, while being a safe asset class, there is interest rate risk there. And I think maybe the initial reversal earlier this week spooked investors to some degree, and people just didn't want to own anything, right? There's this idea that maybe investors wanted to just go into cash and not even worry about interest rate risk and what is usually perceived to be the safe haven investments. The idea of the loss of confidence, though, you know, we don't want to be alarmist, but I think there are some things that we want to consider. And on the one hand, the idea that we're trying to kind of change the terms of our trade and shrink those deficits. We have trade deficits with a lot of countries, and with that, we have capital account surpluses. So those countries, you know, have to own U.S. dollars. They take those dollars and buy U.S. treasuries. If we're trying to change, you know, the terms of trade across the globe, and our trading partners are going to end up with less dollars if we're buying less from them, then there's less of a need, less of an incentive for them to hold U.S. treasuries or as much U.S. treasuries as they've historically held. So it's something to be that we're considering now. You know, we don't want to raise the alarm bells just yet. I think there are a lot of moving parts, but I think it's something that investors and market participants are going to be paying attention to for the next handful of weeks.
Yeah, and you know, decent auctions this week on the 10-year and the 30-year, although the 3-year was weak to start the week. But Mike, you know, you start looking at reasons for this uncertainty in markets and maybe a pushback where, you know, overseas buyers aren't coming into our treasury market, and that, you know, the tariff headlines, right? The consternation that we've seen in Washington. I know that's your forte. So, you know, do we expect this to continue, or is this just the negotiating process that we have to go through to get through it?
Yeah, Tom, I feel like I've been living through a fever dream this week. In 25 years of being in Washington, I'm not sure I've ever seen a week that had more direct connection between policy and a market reaction than this past week. But I think the problem is we don't really know how this is all going to unfold. You know, we've got a 90-day pause. I expect we'll see a bunch of individual country negotiations, but we don't know if that's going to start this weekend with some announcements or 6 weeks from now, or how long this is going to take. And I think that's why we're going to stay in this kind of period of uncertainty, because, you know, the terms that are being laid out there, it's not totally clear what the goal is on a lot of these things. And as Collin just pointed out, you know, if it's about reducing trade deficits, well, that's going to take a long time. And you've got big, you know, trade surpluses by small countries that don't have much money to buy things from us. So I think it's going to be a complex process. And I don't think the market's going to get a lot of clarity out of the White House. I think it's going to be a long, drawn-out process in which you're going to get dribs and drabs of announcements on individual deals, but we don't know what the pace of those is going to be or what the terms are going to be. So I think that we're going to be a little bit in uncertainty for a while now.
Yeah, and I think that's what everybody's a little bit frightened of at this point. But Collin, when you start looking at the yield curve starting to widen out here a little bit, 3-year highs nearly for that 210 spread at this point, the volatility coming into that space at this point. Inflation numbers were good this week, Collin. Is this just the calm before the storm, where maybe we're not, you know, it's backward-looking data, or is the bond market telling us something different?
Well, what we're seeing this week is that the economic data doesn't matter right now.
Yeah.
And I didn't think we'd get to that point, but just my team and I were talking about that this morning, where the past week of data was pretty good. We got a relatively strong labor market jobs report last Friday, and then this week we got surprises to the downside with both CPI and PPI. That's fantastic news. I mean, if this was a month ago and we got that data absent this tariff news, I think we'd probably see lower yields. We'd see expectations for the Fed to continue to cut rates, although technically the markets are doing that right now. But we'd probably see lower long-term yields. I think it's just all the trade uncertainty that's driving markets, and we expect that to continue. I'll piggyback on the points Mike made that we're going to see a period of uncertainty. It's not like next week or even in 2 weeks, we're suddenly going to have clarity and have a firm grasp of how the markets are going to perform going forward. So we expect a lot of volatility, and given that, our guidance hasn't really changed too much. We're focusing on high quality investments. We're not looking to take too much risk right now because we've seen these really wide swings in the bond markets, even with perceived safe havens like U.S. Treasuries. But we worry about the riskier parts of the market that we expect to continue to see high volatility, just given that uncertain outlook.
Yeah, I've been trading these markets down at the SIBO and here at Schwab for 30 years, and it's been crazy this week. And I keep telling all the young people in the office, mark this stuff down, start writing this stuff down, because we're going to be talking about it years from now. Mike, on the other front, with the tax bill and on Congress, what type of impact is that going to have, for maybe markets here moving forward? Is a little bit of a reprieve at this point?
Well, Tom, they've moved forward on Capitol Hill on this big tax bill. They cleared a big procedural hurdle that will now allow them to really focus on getting the details of every tax cut, every spending cut. That's going to be tricky. There's a lot of negotiation that's going to happen on Capitol Hill, and I expect it's going to take us, probably into the summer to get that all hammered out. But I do think that's a positive that's coming down the pike for companies and for individuals. How long it takes and what the specific details are going to have to be worked out. But definitely something to watch and maybe provide a little bit of calmness on the other side of the tariff equation.
Yeah, I do not expect, I just expect over the next 90 days, we're going to get stuff trickling in, as you guys mentioned, but it's not going to come over the weekend. We're not going to get this resolved anytime soon. All right, great discussion, guys. Have a great weekend. That's Collin Martin and Mike Townsend from Charles Schwab.